Hello and welcome to the lecture for Chapter 10. This chapter will give us an introduction to management accounting, and then we'll follow that up with the next two lectures which get into the topic in more detail. But this will give you a good overview. So in this chapter I'm going to compare managerial accounting with financial accounting. And financial accounting is what we've studied up to this point. Talk a little bit about the cost of manufacturing a product. So we'll look at manufacturers, which are a little bit more complicated than service companies in terms of accounting. And then we'll look at the manufacturing costs and financial statements, so specifically how we lay that out and how we report what's going on in the company. I'll define for you upstream, midstream, and downstream costs. Talk about cost of goods manufactured and sold. Talk a little bit about just-in-time inventory, and then standards of ethical practice for the profession. IMA stands for the Institute of Managerial Accounting. So first of all, accounting as a professional field is comprised really of three different types of activities. And oftentimes people will focus on one activity or another in terms of their job and their profession. So financial accounting deals with reporting to the outside world. So how do we report the results of the company's operations to shareholders, to creditors, to the government, to those kinds of entities? How do we say what we did? Jump over to the right there, managerial accounting, that focuses inside the company. So how do we provide information to the managers within the company to make good decisions? Both of those areas of accounting, financial and managerial, both rely on cost accounting, and cost accounting deals with the cost of the products or services that we provide to customers. We need that information for proper financial accounting. We also need it for managerial accounting so we can make decisions about how we go about manufacturing those products or providing those services. So a little bit more about financial accounting. Again, that's what we've been talking about up until this point. So how do we communicate financial results to outsiders? So we need to recognize that each of those different groups have different interests. So owners of the company, which we've been calling shareholders or stockholders, they require financial information about the company so that they can make good investment decisions. Should they sell their investment and pull out? Should they double down and invest more, or should they hold steady? Every investor will make those decisions about the money that they've invested in a particular entity. Lenders, well, you can imagine what lenders care about. They care about getting paid back, so their focus is on cash flow. Is the company going to be able to pay their debts as they come due? Lastly, the government, they care about getting their share. So they care about how the company did in terms of state and local and federal taxation. And again, there are specific rules, of course, about how companies report their taxable income to government entities. But that's, again, the focus is outside the company. Managerial accounting, the focus is inside the company. And with financial accounting, we have rules that we have to follow, so there's consistency and comparability. Those rules are called generally accepted accounting principles. In managerial accounting, there are no rules. It's basically, what do you need to do to produce the most accurate, most relevant information so that people could make good decisions? So it facilitates planning for the business and control that goes on in the business. So you can imagine if you're an operations manager, maybe you're a factory manager or a production manager, you need to know about the costs of what you're doing. If you decide, well, I'm going to change the orientation of my assembly line and I'm going to staff it differently, well, did that increase my cost or decrease my cost? Without accounting, I wouldn't know what the impact of my different decisions would be. So what's the optimal production method? I want to control inventory. We'll talk about that in a little bit when I talk about just in time, but I need to know about cost in that regard as well. Of course, if you're a sales and marketing manager or you're a Salesforce manager, you want to know about the effectiveness of your sales force. So who's doing well, who's not doing well, who needs help, and who should be set out as an example for others to follow. What about the product mix? In most companies, you have multiple products, maybe multiple product lines, and they're probably not all equally profitable. So how do we manage which we promote and which we de-emphasize based on profitability? And then, of course, profitability by product. I guarantee you, there are companies that you will work at in the future that have products that are not profitable. They cost more to make than they're selling them for. Oftentimes that's because companies just don't have enough good information to know that's the case. Obviously, if they increase their sales of those products, they will either decrease their profits or increase their losses. And then financial management needs to know what is the future of the company, so we can plan for either investing excess cash or making sure that we borrow or raise the money that we need to fund our operations. So in a manufacturing operation, a company will take cash or financial assets and they'll use that to initiate the manufacturing process. There's always three types of cost involved in manufacturing a product. There are direct materials or raw materials. That's the stuff you need to buy from suppliers to turn it into a finished product. There's direct labor. Those are people in the process that are actually converting those raw materials to a finished product. So they're sawing and drilling and doing whatever, welding, bending, all of those kinds of activities. They're using machinery or their hands to transform the product. And then I don't really like the graphic there for overhead. Overhead is all of the other manufacturing costs that are required but are not included in direct materials and direct labor. So the cost of the factory supervisor, the rent for the factory, the electricity for the factory, the forklift drivers that move material around. It's all the costs that are required for there to be a factory, all the support costs. That ends up resulting in finished goods. So which is an inventory, it's an item on our balance sheet, and those costs will stay on our balance sheet until we sell them to a customer. Once they're put in the customer's truck, they become cost of goods sold and appear on our income statement. So we might have a factory that is really busy all month long, incurring lots of material costs, a lot of labor costs, a lot of overhead. If we don't sell anything, all of those costs are going to be on the balance sheet until we actually sell them. We'll own inventory. So here's an example of specifically labor costs. So we might have two different kinds of employees in our company. We might have production employees and then office employees, selling and admin. When I incur labor costs for production employees, those costs, think about them attaching themselves physically to the product in a way. So they're going to follow the product. So those production wages are going to go into inventory in the balance sheet. And then when the product is taken off the shelf and sold to a customer, they'll appear on our income statement. Office salaries like salespeople and office assistants and accountants and all of that, their salaries are expensed immediately. There's no inventory to attach those costs to because they're not directly related to manufacturing of products. So they're immediately expensed as incurred. Here's an example of a set of financial statements for a manufacturing company. So the key thing here is that in the past we've just had revenue and expenses. Now we've got a little more detail. So because we're selling product, we have sales revenue, and then we have cost of goods sold. So I charged customers $7,500 for products. Those products cost me $4,000 to make. So I end up with gross margin of $3,500. That is a really important number for any manufacturing company. What portion of their revenue is left over after they deduct the cost of making the product? That's important in a dollar amount. It's important as a percentage of sales as well. Then I've got what some companies call overhead, selling, general, and administrative expenses. This company had salary, expense, and depreciation to get down to net income. So it's a little bit more complicated. On the balance sheet, I'm going to now have finished goods inventory on my balance sheet. So a little bit about types of costs in a manufacturing company. So the book talked about upstream, midstream, and downstream costs, and I want to take a minute to define those to you. So an upstream cost is a cost that's incurred before we start the manufacturing process. So it might include research and development or product design. It might include product testing. It might include some engineering cost for setting up how we're going to do the manufacturing. So it's all the costs that are related to the product that are incurred before we start making it. Midstream costs are the costs I've been talking about: direct materials, direct labor, manufacturing overhead. It's the costs that are incurred while we're manufacturing the product. Downstream cost, makes sense, would be cost after we finish manufacturing the product. So it's how to tell customers about it. It's how to get the product to customers, so distribution, warehouses, all of that. And then customer service. After customers have the product in their hands and have problems with it or have questions, it's servicing those customers. So those are downstream costs. Kind of a useful way of thinking about things. This next financial statement is a little bit more complicated. It's what we do to determine what the cost of the goods we sold was. And it's really focused on those three types of cost I talked about before: materials, labor, and overhead. So the first one there, determining how much raw material we used, there's kind of a little subroutine that we'll see in several places here. We say, what was our beginning material inventory? What did we add to it, which was purchases? And then what was left at the end of the month. If we subtract what was left at the end of the month, then the gap there is what was used during the period. And it may have been used in production, it may have been lost due to scrap, whatever, but it's an expense. It's materials that went away. So we have that to determine how much raw material did we use in production during the month. I add to that labor that was incurred. That comes from payroll for our factory workers. And I add overhead, the cost of the supervisors and forklift drivers and lights and all of that. That tells me the total manufacturing costs that were incurred during the period. Then I can do that little subroutine again. I can add that to my beginning work in process to tell me what my total work in process is. That's product that's in the process of being made. And then I subtract what was my ending work in process. That's usually a fairly small number, and it's what was on the workbenches in the factory when they blew the quitting whistle at the end of the month. So that'll tell us the cost of the goods that were manufactured. So the cost of the goods that were completed and left our factory, that's $94,600 in this case. We can add that to our beginning finished goods inventory. Finished goods are product that are all done, ready to be given to a customer. So we started the month with some products like that. We add the cost of goods manufactured. That tells us the cost of the goods that were available for sale that could have been purchased by customers. We take an inventory count at the end of the month. That tells us the ending finished goods inventory. When we subtract that, that tells us the cost of the goods that were actually placed in the customer's truck or shipped to the customer. So it's a bit of a complicated statement, but you can kind of see that it's trying to get at what was the cost of what we gave to our customers. Next topic is a popular topic actually now. Many companies are engaged in efforts to implement just-in-time inventory. Another term for this is lean manufacturing, but it's an effort to try to reduce as much as possible the inventory that is in the system, whether it's raw materials, whether it's work in process inventory, or whether it's finished goods inventory. Companies want to reduce that as much as possible. The reason they want to reduce that inventory as much as they can is they want to reduce the costs that are associated with inventory. So if you think about it, the more inventory you have, the bigger the warehouse you need. Warehouses cost money for rent or buying them. And once you have that warehouse, you need racking and you need forklifts, and then you need propane for the forklifts, and you need forklift drivers and supervisors for the forklift drivers. There's all kinds of costs associated with having the warehouse, insuring the inventory, heat and lights for the warehouse, all of those costs. The more inventory you have, the more you spend in that regard. Also, the more inventory you have, the greater the likelihood is that some of it's going to get damaged. People are going to run into it with forklifts, all of that kind of stuff. And of course, damaged product gets thrown away and it's a cost to the company. As is theft. The more you have, the more likely you are to have something stolen. The other cost, obsolescence, means if we have a whole bunch of product on the shelf and we come out with a better way to make a mousetrap, a better product, some improvement that customers have been asking for, we're faced with the decision of either implementing that improvement to make our customers happy. Well, if we do that, then we're going to throw away all the old inventory that's on the shelf. Or we'll use that inventory and wait to implement our improvements, which isn't good either. So it puts you in a bit of a quandary. And then last and probably most important is financing. So inventory costs money. Think about it as putting stacks of money on the shelf in your warehouse. Now you don't have that money to pay your bills with. None of your employees will accept inventory in lieu of pay. Your landlord won't accept inventory in lieu of rent. So all of that money that is tied up in inventory is not available to you in the form of cash to pay your bills as they come due. So that's really what drives companies toward just-in-time inventory. Now, recognize that there is a cost of not having enough inventory. If you have and certainly we've seen that during the last year and a half with COVID, where it's disrupted the supply chain, where ships don't get unloaded on time, other factories close down. And if you're running your inventory too slow, it would mean you could be in a stock out situation where you don't have enough inventory to satisfy your customers' needs. So that's the downside to just-in-time inventory. The last slide here deals with ethics for managerial accountants. So these are accountants. This is what I did for a large portion of my career as I worked inside a company doing accounting work. And so one form of ethics is to not undertake duties that you're not prepared to complete. So if you haven't been trained properly, if you don't have the expertise, then don't jump in and try to figure it out as you go. Say, I can't do that, somebody else should do that, or we should hire a consultant to help us with that. Better to do that than to do something incorrectly that other people will then rely on. Second, don't disclose confidential information. So you shouldn't talk to other people about what is going on in the company from a financial perspective. You only share that with people that have a need to know. Third, don't compromise your integrity through falsification, embezzlement, bribery, all of those kinds of things. You can't do that. Once you cross that line, there's no real coming back from that. And then lastly, don't issue biased, misleading, or incomplete financial reports. There is often pressure on accountants in a company to issue reports that make things look better than they really are, and you have to resist that. People can't make decisions based on incorrect information, so don't do that. Thank you for your attention. That's the end of the lecture for Chapter 10. I look forward to talking to you in the lecture for Chapter 11 next. Thank you.